Hey everybody, it's Matt. I wanted to spend a few minutes talking about these new Trump accounts that you may or may not have heard of. The federal government has started rolling out new investment accounts that go by the name Trump accounts. And I've had some inquiries from clients and people that are curious about what these accounts are, how they can be used. And so let's go through and talk about what we know, what we think we know, what we don't know yet, and try and give you the lay of the land. Okay, so the first feature of these accounts that I get asked about the most are the $1,000 contribution that you get just for opening the account. Not everyone is going to get that. Your child has to have been born between January 1st of 2025 and by December 31st of 2028. So if you do meet that criteria, if you have one child, more children born during that window, then just by opening the account, there will be a $1,000 seed contribution that comes from the federal government. If you don't have children born during that time period, it doesn't mean the accounts aren't useful for you, but you will miss out on that $1,000 seed. The next thing we know is that there is a $5,000 annual cap on contributions. And this cap includes all types of contributions. So, whether it's from your own family, whether it's from extended family, grandparents, friends, even your employer can actually make up to $2,500 in contributions on your behalf. That is tax free income for your family that goes straight to the Trump account. But when they do that, they've already filled half of the $5,000 annual limit. So you just need to be aware of that. You don't want to over contribute to the accounts. But as the plan is being rolled out right now, it's pretty straightforward. It's just a $5,000 annual contribution limit from all sources combined. There's no upfront tax break for making that contribution, but we'll get into the taxation of this here in a little bit. So, when we're making contributions to these accounts on behalf of our children, there's a natural question about who actually controls the account, who controls the money, who makes the decisions. And until the child reaches age 18, it is you, as the account owner, usually a parent or family member, something like that, who has complete control over the account. As we get into a comparison with other types of accounts that benefit our kids, we'll talk about what investment options are actually available to you. But of the menu of investment options that are available to you, you're the one that's in control of the account, and your child does not get control of the account until they reach age 18. Now, once they reach age 18, this may be somewhat dangerous, and you really need to think hard about whether you want this to happen with your child. The account becomes the child's account fully. They can use the money however they want. There may be penalties for using it for ill advised purposes. But that being said, the account is theirs, and you need to be sure you're comfortable with your 18-year-old child inheriting or gaining control over whatever balance is going to be in that account at that time. So, this is where the rubber really meets the road in terms of thinking about Trump accounts, how they fit into your broader financial plan, how they fit into your family's broader financial picture, and in particular, how they compare to 529 college savings plans. When people think about saving money on behalf of their children for their children, one of the first things they think about is saving for college. And if your primary goal is to save money for college that your child can use to benefit, whether it's undergrad, grad school, even private school on the way to college, it's pretty clear to me that the 529 plan generally wins. The advantages of a 529 plan, well, first, they may be tax deductible in your state. Your contributions are not tax deductible at the federal level, but if you live in a state where there's a state income tax, it's quite possible that your contributions are deductible at the state level. So that's a nice little upfront benefit that you can get from the 529 plan. Also, really important to me, the 529 plan can stay in your ownership and control indefinitely. It does not ever automatically turn over into your child's plan and into their control. And there is some flexibility with 529 plans in that you can change beneficiaries. So if something happens where your child doesn't need the money, or maybe they go a different route, trade school, something like that, you can always name a different beneficiary for the account. Inevitably, if you do have money left over at the end, there is a way to start rolling some of that money over into a Roth IRA. So there is some flexibility there with the 529 account. Um, and I guess the final thing is with the taxation aspect of it is that when you make a qualified withdrawal from a 529 account to pay for educational expenses, that withdrawal is tax free. So you may have had an upfront tax benefit if your state gives you an income tax break for your contributions. You get tax deferred growth along the way while the account is invested and growing, hopefully growing. And if you take the money out for a qualified education expense, then that withdrawal is tax free. So if you're saving for college, the 529 plan really is gonna win out because on the Trump account side, there is no federal tax deduction, just like there's not with the 529. But I'm also unaware of any states that intend to give a upfront tax deduction for contributions to the Trump account. Trump account does win if you have children born between January 2025 and December 31st of 28, and they get that $1,000 seed money. But frankly, I think the upfront contributions being tax deductible at the state level can overcome that pretty quickly. Trump accounts are more broad in your ability to use them for qualified expenses. They mention things like education, buying a first home, or starting a business. So they're a wider range of things that you can use a Trump account for and still have it be of qualified use. But the contribution limits on Trump accounts being at $5,000 are just dramatically lower than they are for 529 plans. 529 plans, they're administered by the states, and so each state will have its own contribution, or I guess account contribution total limit, and it's usually in the hundreds of thousands of dollars. Most people look at the annual gift tax exclusion, which for 2026 is $19,000 per person. So a married couple, each of you has $19,000, so that's $38,000 total. And then with 529 contributions specifically, you're allowed to do what's called bunching, where you can actually use up to 5 years of those $19,000 contribution limits before you even have to file a gift tax return. And filing the gift tax return doesn't mean you're actually going to pay taxes on the gift. You have a lifetime limit on how much you can give, and right now that's above $10 million. I think it's something like $12 or $13 million. So if you wanted to, a married couple could do 38,000, 5 years worth, bunched together and contribute a really significant amount to have that account funded and ready to go for your child. So those contribution limits do make a big difference. However, if you're not going to be using the account primarily for education and you want to have broader uses, then the Trump account does add more flexibility. So there's no reason that you can't have both. It just depends on what your goals are. As we put this all together, let's think about what your savings waterfall might look like now that we have these Trump accounts available to us in the context of some of the other popular account types that are out there. So first, you have to focus on your own retirement and financial security. We haven't really focused on that during this presentation, but it's just paramount that you make yourself financially secure first and keep that as your number one priority, because then you can always help your child later on in life if and when it's needed. Your child can borrow money for education. They can borrow money to buy a house. They can borrow money to go to school, to start a business. But you're not able to borrow money for retirement, or at least it's a pretty bad deal for you if that's the case. So focus on your own retirement and financial security first. Next, taxable brokerage. This is just a regular traditional investment account. This is one that is not earmarked for any specific use. It doesn't get a tax break because it's a retirement account or a health-focused account or an education-focused account. It's just a standard regular investment account, and you want to make sure that in addition to your retirement funds that you have some liquid investments that you can use prior to retirement age. When we get down into the kids area, we can start thinking about Roth IRA, particularly if they have like summer jobs. Well, really, if they have legitimate work and legitimate earnings. You may hear gurus on TikTok or Instagram talking about ways to get your children into a Roth IRA by doing baby modeling or things like that, but that's typically not really a great idea. But a lot of kids, as they get older, do have summer jobs. Maybe they babysit, maybe they work at a camp. Who knows what they do? But there's a lot of legitimate ways for children to earn money. And if they do have earned income, it is a great idea to open a Roth IRA for the kids and let them get started with investing and start building tax-free growth for decades to come. Next is the 529 college plan. To me, I still think this is better than a Trump account overall, particularly, if we're focused on paying for education. Education costs for our children are going to be, if not the most expensive thing we do for our kids, it's going to be among the most expensive thing we do for our kids. So I really like the 529 college savings plan. There may be an upfront tax deduction at the state level. There's tax deferred growth. There are tax-free withdrawals if they're used for qualified expenses, and the contribution caps on 529 plans are dramatically higher than they are for the Trump accounts. After that, you could do a Trump account. There's no reason you can't have a Trump account in addition to a Roth IRA, a 529. A Trump account can be fine, particularly if your child is born in that date range of January 1st, 2025 to December 31st of 2028. There's no reason to not go collect that air quote free money that they're going to add, the $1,000, which probably coming from you as a taxpayer. But nonetheless, there's no reason that you shouldn't go get those recycled tax dollars, put them back into the child's account, and go ahead and save there too. Because if you put $5,000 away in these accounts and you put more into a 529, then you can earmark the 529 for education expenses. And maybe you want to give the child flexibility when it comes to buying their first house or potentially starting a business. You do have more flexibility with how the funds are used in a Trump account. Last would be the custodial account. The reason I put the custodial account last is because there is no upfront tax benefit, nor is there any ongoing tax benefit like deferral of taxation on growth and interest in the accounts. So there's not really a tax benefit to it, and I just don't love the idea of a child or a brand new adult getting access and full control to an investment account somewhere around age 18 to 21, depending on which state you're in. And these custodial accounts do become the child's account once they reach the age of majority. So to me, it's just a little bit dangerous. I traditionally like to see clients just open brokerage accounts in their own name. The parents can open their own brokerage account, and then they can just mentally earmark that account to be for the benefit of their child, but it doesn't automatically become the child's money until the parent is ready for that to happen. So that's what kind of the way I think about these. There is a place for them. There is a purpose for them. They have some kind of unique aspects and quirks. They're hybrids of other different types of accounts. They're certainly worth a look. They're very, very easy to sign up for. I think it's trumpaccounts.gov, and you can go ahead and get one open and at least get the $1,000 if you qualify for it, and then consider what you want to do with it from there. Hope this is helpful. Thanks.